Time now for Options Corner. Joining us to take a deeper look at the chart for Apple is Rick Ducat, lead market technician. All right, Rick, when you take a look at this chart, what trends do you notice?
Apple's had a bit of a resurgence recently. Now it's about on par with the S&P 500, the broader market here. But we can also see notably underperforming its own tech sector still, which is up about 22.5% versus Apple up about 13%. Apple, for a while, also had the rather dubious distinction of being the worst performer out of the Mag 7. But with its recovery, it's pretty close now back to the rest of this group, which is up about 17% as a whole. If we were to look at Apple a little more specifically, what we have is a situation where we have a rising wedge type of pattern here, our two trend lines converging toward each other after we recently hit these all-time highs of 288.62. Notice that we have our old highs here. That's the supportive area to watch going forward now, near about 279 or so. We also had this short-term range period that gave us our floor, 265, an old high, that then became subsequent lows several times. So a very shorter term range here, 265 to about a 277 or so. So now if we were to look at our moving average studies here, our weekly 5-day EMA price had given it up last week here, but we've still remained within the boundaries of our wedge type shape here. So hanging on for there. And if we were to move a little bit lower, our 21-day EMA comes in at right about 275. Notice that RSI reflects our slowdown in momentum here. We are out of the overbought area. We are below our trend line, which has been broken now, our green line there. So momentum slowing, price starting to wane. Look for that breakout below that trend line there. We can also see our volume node lines up very closely with our range-bound area there, near about 275 or so. Volume doesn't really pick up again until down here near about 255. Finally, when we look at our expected move area here, December 19th, 11 days out, about an expected move of 3.3% or so. For January, 39 days out, roughly 6%. So if we were to break out above that 277 level, and then we would have our sights set here around 295. That's the upper edge of our range. That's also where our +2 standard deviation channel comes in. So a relatively extreme move is where that one would line up here going forward.
Thank you, Rick. That is Rick Ducat, the Duke of Data himself, taking a look at the trends in Apple. Now, take us through an example trade. We've got Tom White, co-host of Fast Market and senior options contributor. All right, Tom, this is a really bullish call from Dan Ives, which I know he's a bull in this one, but like the price target it's very high from here. I find that interesting. What's your take on your approach for an example trade, especially given also Rick pointed out that momentum is slowing?
Yeah, not a shocker here, getting a positive call. Evercore ISI just came out with a note also. They put a $320 price target on it. So across the board, but we've seen good positive data out of Apple, not only domestically here in North America, but also China sales. Maybe going to start to overtake the Google Alphabet phones over there also as far as market share also. So a lot of positive momentum on this one. So I looked at, they don't have earnings until the end of January, so I kind of want to avoid that event. But I looked at a strategy that takes advantage of a move higher while using or giving myself some duration on this bullish trade. So looked at a bullish call vertical here where I'm going to buy something slightly in the money. The stock's going to open up just below 278 here. We're only about 3% off of those record highs that we saw last week. We're going to go out to the January monthly cycle. So 39 days to expiration. We're going to buy a call vertical where it can offset some of the risk or costs on this bullish position. We're going to buy the 275 strike call. That's good, slightly in the money by about $3. That's the bullish portion of this trade. And then against it, to offset some of the risks on that, we're going to sell the 295 strike call. So a bullish $20 wide call vertical here. You're going to pay roughly about an $8 debit if the stock opens up here just below 278. If you pay that $8 debit, there's your risk, $800 per spread. You can make up to $1,200 on this spread if it goes above 295 at expiration over basically the next 6 weeks. $8 debit takes your risk up to 283 to the upside. That's only about 1.8% above the current share price. So you're not too far below where you need the stock to go to get above that break even here. Pretty good risk reward setup. I think one of the keys when doing directional biased verticals like this Yeah, you're capping some of your gains, but you're also capping the amount of risk you have on it. But implied volatility levels, the IV percentile rank, only about 9%. So we're in the bottom 10% of implied volatility levels that we've seen over the last 52 weeks. So buying verticals in a low volatility environment lowers that initial cost and risk on this bullish trade. But you only need less than a 2% move to the upside to get above that break even at 283 on this bullish call vertical.
All right. Thank you, Tom. Appreciate that. That's an example trade there for Apple off the back of a more bullish view from Wedbush's Dan Ives.